Assalamualaikum and hi, my name is Nurshadina binti Ramlan. My matrix number is 159356. In this assignment, my groupmates and I have chose two companies, which is DG and Maxis. In this video, we will be sharing the trend of analysis based on the financial ratio that we have been completed. So let's get started. So the first one is introduction of company. The first company is DG company. So DG Berhad provide telecommunication services. DG commenced operations in May 1995 when it launched its fully digital GSM 1800 services, the first digital mobile communication service in Malaysia. The company was founded in 1995, based in Shah Alam, Selangor, Malaysia. DG also listed in Bursa Malaysia under the main market. The next company is Maxis. In 1995, Maxis was one of the first mobile communication providers in Malaysia. It provides a variety of communication products, applications, and value-added services for consumers, larger enterprises, as well as small and medium business owners. Maxis also listed in Bursa Malaysia under the main market.
My name is Nur Sahira binti Zunaidi. So my topic is asset ratio. Asset ratio or quick ratio compares a company's more short-term assets to more short-term liability to see if a company has enough cash to pay its immediate liability such as short-term debt. So, the higher asset ratio, the better liquidity position of the company. So, there are two formulas you can use to calculate the asset ratio or quick ratio. So, the first formula you can use is current asset minus inventory divided by current liability.
So, another formula you can use is cash plus cash equivalent plus marketable security plus current account receivable divided by total current liabilities.
So, this is the graph of asset ratio between DG versus Maxis. If asset ratio is less than 1, it shows that the company may not be able to fully pay off its current liability in the short term. But if the asset ratio is greater than 1, it means that the company can instantly get rid of its current liabilities. So based on the graph, you can see that both company DG and Maxis has asset ratio is less than 1. So it shows that both company may not be able to fully pay off its current liability in the short term. So based on the graph, DG has increased from 2016 to 2017. But then it fell down in 2018 to 2020. While for Maxis has increased from 2016 to 2017, but then decreased in 2018 to 2019, and increased in 2020. Based on the graph, it's obvious that DG has higher asset ratio compared to Maxis. In 2020, DG asset ratio is slightly lower than Maxis, but for overall performance, DG has better asset ratio compared to Maxis because DG highest ratio is 0.80, while Maxis is only 0.63. It indicates that DG had the ability to pay without having to rely on liquid current asset is 0.80 for RM1 of its short-term liabilities.
Hi everyone, my name is Nur Alena Sofia binti Shuaimi. Inventory turnover is a financial ratio showing how many times a company has sold and replaced inventory during a given period. The formula for the inventory turnover is equal to cost of goods sold divided by average inventory. The inventory turnover for Maxis increased from 2016 to 2019 but decreased from 2019 to 2020 by 2.01. Next, inventory turnover for DG decreased from 2016 to 2020 by 12.98. The higher the turnover figure, the less time an item spent in inventory and the better the return to be earned from fund tied up in inventory. Thus, 3065 days equal to 39.50 equal to 9.24 days. Mean DG holding inventory for about only 9 days. The higher the turnover figure, the less time and items spent in inventory and the better the return to be earned from funds tied up in inventory. Thus, 3065 days divided by 3.10 equal to 170.7 days, mean Maxis is holding inventory for about only 118 days.
Account receivables ratio tells you how good a job your business does at collecting invoices. The ratio is used to measure how effective a company is at extending credits and collecting debts. The formula for account receivable ratio is net credit sales divided by the average account receivables. Since the receivables turnover ratio measures a business' ability to efficiently collect its receivables, it only makes sense that a higher ratio would be more favorable. Higher ratio means that companies are collecting their receivables more frequently throughout the year. Low account receivable ratio means that the company policies are not strict enough or having issues with debt collection. So the account receivable turnover ratio for Maxis increased from 2016 to 2017, but it decreased dramatically from 2017 until 2019, but it went back up in 2020. Meanwhile, for account receivable ratio DG, it increased dramatically from 2016 to 2017, but it decreased from 2017 to 2018, but there was a considerable increase from 2018 until 2020. So based on the graph, it shows that in 2017, Maxis collected its highest receivables 8.52 times on average that year. A high receivables turnover ratio indicates that Maxis' collection of account receivable is efficient, and the company has a high proportion of quality customers that pay their debts quickly on that year. Meanwhile, also in 2017, it shows that DG collected its highest receivables 15.89 times on average that year. The excellent turnover rate suggests a very strong credit and collection policy of DG.
Asset turnover ratio measures the efficiency of a company's asset in generating revenue or sales. It compares the dollar amount of sale to its total asset as an annualized percentage. Formula for asset turnover is net sales divided by average total asset. A high total asset turnover ratio shows that corporate resources are being well managed and the company is able to realize a high level of sale from its assets investment. Low asset turnover ratio shows that a company is not effective using its asset to generate sales. Based on the graph, asset turnover for DG decreased from 2016 to 2020. DG recorded 1.14 times for asset turnover in 2016, which is the highest amount of 5 years. It indicates that DG is generating RM1.14 in revenue from every RM1 invested in asset. Next, asset turnover for Maxis slightly increased from 2016 to 2017 and sharply decreased from 2017 to 2020. Maxis recorded 0.49 times for asset turnover in 2017, which is the highest amount of 5 years. It indicates that Maxis is generating 0.49 cents in revenue from every RM1 invested in asset. As a conclusion, higher asset turnover is better for companies' performance. So, asset turnover for DG companies is better than Maxis.
Debt ratio is a solvency ratio that measures a firm's total liability as a percentage of its total assets. In a sense, the debt ratio shows a company's ability to pay off its liabilities with assets. Formula of debt ratio is total liabilities divided by assets. These two companies shows that the debt ratio are less than 1.0 or 100%. If a debt ratio is 0.6 or higher, it makes more difficult to borrow money. But if the debt ratio is 0.4 or lower, are considered better. Based on these 5 years, DG company in 2018 has the most lowest of debt ratio. The debt ratio is 0.89. So, the 2018 is the most stable years for DG with the potential of longevity. Then, based on these 5 years, Maxis company 2017 and 2018 has the most lowest of debt ratio. The debt ratio is 0.64. So, 2017 and 2018 are the most stable years for Maxis company with potential of longevity. In conclusion, Maxis company is have a good debt ratio, which means have a poor risk perspective than DG company.
Next is time interest earn ratio. Time interest earn ratio is measure of company's ability to meet its debt obligation based on its current income. It can be calculated by using the formula of operating income divided by interest expenses. Based on the trend analysis, we can see that Maxis started with 6.29 on 2016 and increased rapidly by 22.42 on 2017. Then it kept decreasing by 7.20, 5.46 and 4.87 on 2018, 2019 and 2020. For DG, it started with 29.91 on 2016 and decreased by 16.03 on 2017. After that, the ratio increased by 16.92 on 2018 and constantly decreased by 8.7 and 7.4 on 2019 and 2020. From an investor or creditor's perspective, the company that has a time interest earned greater than 2.5 times is considered an acceptable risk. For time interest earned, the higher ratio is favorable as the company is able to cover the debt payments. Based on the data, it shows that both Maxis and DG can afford to pay additional interest expenses each year and still in acceptable risk state. However, Maxis might facing difficulty in the future as the ratio keeps decreasing each year.
Net profit margin is used to measure the percentage of profit a company produces from its total revenue. It measures the amount of net profit a company obtains per dollar of revenue gained. The formula of net profit margin is net income divided by total revenue and multiplied with 100. Based on the data, the net profit margin for DG is inconsistent from 2016 to 2018 and decreased steadily in 2020. The net profit margin for Maxis is unchanged from 2016 to 2017 and declined gradually until 2020. In 2016, DG has recorded 0.28, which is the highest net profit margin among 5 years. Meanwhile, both DG and Maxis has stated the same amount in 2017, which is 0.23. A high net profit margin means that company is able to effectively control its costs and or provide goods or services at a price significantly higher than it costs. Therefore, a high ratio can result from efficient management, low cost, which is expenses, and strong pricing strategies. A low net profit margin means that a company uses an ineffective cost structure and or poor pricing strategies. Therefore, a low ratio can result from inefficient management, high cost, which is expenses, and weak pricing strategies. Investors need to take number from the profit margins ratio as an overall indicator of company profitability, performance, and initiate deeper research into a cause of an increase or decrease in the profitability as needed.
Hi, my name is Nabila Husna binti Abdul Halim. Return on asset. So, what is meaning for return on asset? Return on asset or ROA is a measure of the productivity of all capital invested in a firm. A high ratio indicates that the firm can generate a high return for every dollar invested in asset. It also determines how efficiently a company uses its asset. The formula we use to calculate the ROA for Maxis and DG is a net profit after tax divided by total asset and multiplied with 100. The table shows the percentage for both companies. As you can see, the trend analysis shows that ROA for Macy's in 2016, Macy's generated a return on asset of 10%, which improved by 1% in 2017, which is 11%. Then it fell for 3 years in a row by 2% and 1% in 2018, 2019 and 2020, which is 9%, 7% and 6%. This obviously demonstrates that Macy's ROA during those 5 years was not very excellent. Let's take a look at the ROA for DG. In 2016, it had a highest ROA of 28% compared to the next 4 years. It began to fall in 2017 and remained at the 25% in 2018. Its ROA percentage fell by 7% in 2019, which is 18%, and by 3% in 2020, which is 15%. It is obvious that while DG ROA is declining, its percentage against ROA is still very high when compared to Macy's. As we all know, DG profits are highest than Macy's.
Return of equity. What is the meaning of the return of equity? Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity. Shareholders' equity is equal to a company's asset minus its debt. Return of equity is considered the return on net assets. Return of equity is considered a gauge of a corporation's profitability and how efficient it is in generating profit. So the formula for the return of equity is net income minus by preferred dividend and divided by shareholders' equity. Return on equity measures how efficiently a firm can use the money from shareholders to generate profits and grow the company. Investors want to see a high return on equity ratio because this indicates that the company is using its investors' funds effectively. Higher ratios are almost always better than lower ratio. Return of equity for DG is decreasing from 2016 to 2020, while return of equity for Macy's is also decreasing from 2016 to 2020. But based on the data, it clearly shows that DG has higher return of equity and it is more likely to provide better returns to investors compared to Macy's.
And next one is earning per share, or we call it as EPS. EPS indicates that the profitability of a company is the portions of a company profit that is allocated to every individual share of a stock. The higher the earning per share of a company, the better is its profitability. So how we want to compute earning per share? Normally we use the formula EPS is equal to net income minus preferred dividend divided by weighted average share outstanding to compute earning per share. EPS for DG and Macy's. The blue line here is show for EPS for DG. EPS for DG increased from 2017 up to 2018, but then decreased from 2018 to 2020. As we all know, earning per share is referred to the percentage of the company earning that is assigned to each outstanding share of a common stock for a certain period of time. So high level EPS indicates that the company is more profitable and potentially a worthwhile investment as it offers a significant dividend for the investor. And then the red line here show for EPS for Macy's. EPS for Macy's increased from 2016 up to 2017 and then decreased significantly for 3 years from 2017 and 2020. So the lower earning per share indicates that the company profit has reduced, may be caused by a poor fund management, so investor will get less profit if their EPS is low. So as we all know before, the higher the earning per share of a company, the better is its profitability.
Other consideration in making investment decisions. First, inflation rate. Inflation is the continuous rise in the prices of general goods and services, which leads to a decrease in the value of money. When the inflation rate rises, the purchasing power of consumer decreases. A good investment should have a return on investment that is higher than the inflation rate. Some investments, such as property and shares, are positively impacted by inflation. Their value can increase as inflation rises. Second is volatility or fluctuation on investment market. Volatility is a rise and fall of market prices. If a market goes through frequent swings or fluctuation, it is seen a high volatile. Low volatility means that investment, market, or economy is stable. Before making an investment, the investor should consider the fluctuation in national and international economic trends. The level of volatility will have an impact on the same amount return that the investment yields. Market volatility is usually associated with investment risk.
Malaysia is like the rest of the world is adjusting to the new normal centered around digitalization and internet connectivity. Lockdown or no lockdown, COVID-19 pandemic has revealed gaps in Malaysia's digital infrastructure and network performance as people increase their use of internet. We all come to the conclusion and agree that based on the overall financial analysis, Digi outperformed Maxis. The future outlook of the both company in relation to the present development in year 2021 and 2022 is that there will be a drop on debt ratio and increase in return on asset, net profit margin, inventory turnover, and asset turnover. This is because telecommunication industry remains sustainable despite the challenge posed by COVID-19 pandemic, as the rise in online transaction as well as online learning and work from home activities boosted demand from its services.